I am Mike D, and this is the history of money, banking, and trade. Today we're going deep into Rome. Not the Rome of triumphant generals and marble temples, though those were here too, but the Rome of counting benches and wax tablets. The Rome of money changers listening to the coins ring in the forum. The Rome of private banking dynasties financing grain shipments from Egypt, and slaves who rose through the financial system to become the great personal bankers of emperors. The Rome that built the most sophisticated financial infrastructure the ancient world had ever seen, and then slowly let it rot. Because here's the thing, you can't understand Rome without understanding its money. You can't understand its money without understanding where it came from, who controlled it, and what it cost. Let's start with what money actually does. Finance has four essential functions. It reallocates economic value through time, letting you move resources from the future into the present, or from the present into the future. It reallocates risks, spreading the danger of any single venture across many participants. It reallocates capital, directing investment towards productive uses. And it expands across all these things, making them available to more people and enabling transactions of even greater complexity. At its core, every financial contract is a bet on the future. It crosses the barrier of uncertainty that separates what we know now from what we don't yet know. And that uncertainty is exactly why finance is both so powerful and so prone to spectacular collapse. Think about it this way. A farmer can borrow to buy seeds, plant them, and yield a harvest worth far more than the original loan. Without access to that credit, the land sits idle. Finance removes the prerequisite of wealth from entrepreneurship. It feeds capital to productive projects regardless of whether the entrepreneur happens to be rich. Of course, it does help to be rich in the first place, but that's either here nor there. The Romans understood this intellectually, but their elite found the whole business distasteful. And that tension between what finance made possible and what Roman aristocrats believed about who should be doing it runs through the entire story we're going to tell today. To understand Roman finance, you first have to understand Roman class attitudes. And for that, you need to understand Marcus Tullius Cicero. Cicero was born in 106 BCE, rose to become one of Rome's greatest orators and statesmen. He served as consul in 63 BCE and was eventually executed on the orders of Mark Antony in 43 BCE. His head and hands nailed to the speaker's platform in the Forum as a reminder of what happens to men who question the powerful. He was, by any measure, one of the most remarkable figures of the late Republic. He was also, when it comes to commerce and finance, a deeply committed snob. Cicero's worldview, laid out mostly fully in works like On the Republic and On Duties, was built on the vision of a morally ordered market. But the key word is ordered. Commerce was acceptable when it occurred between men of good character and social standing. Agriculture was the foundation of genuine wealth and virtue. Large-scale land ownership was the only true good form of economic activity, producing the kind of upright citizens and soldiers the Roman Republic needed to function. Everything else was suspect. He used the term mercator, which was merchant, as an insult. Professional moneylenders, he believed, were people of lower character by definition. Finance existed to serve the ruling class, not to create an independent class of wealthy non-aristocrats. In Cicero's framework, markets worked best when confined to the closed network of elite friendship and mutual obligation, what he called the common bond of kindness. rather than thrown open to everyone with capital to deploy. What is remarkable is that Cicero was groping 1800 years before Adam Smith towards something that resembles free market theory. He believed that when ethical men of good character exchanged goods honestly, markets would regulate themselves towards equilibrium without requiring constant government intervention. Trust was the mechanism. Ethics were the lubricant. The market could work on its own as long as the right people were running it. But his version of the right people was a very small group indeed. 700 or so senatorial families at the top. About 30,000 equestrians, which were the wealthy knights, below them. 5 million full citizens receiving free bread and enjoying legal rights. And then the tens of millions of non-citizens, freedmen, and slaves below that. That was not a vision of universal economic participation. It was a justification for a closed, oligarchic system in which the elite wealth sustained itself through the labor of everyone beneath it. And finance served the purpose of the powerful while remaining philosophically beneath their dignity to practice. The peasant was meant to remain a peasant. The slave was meant to remain a slave. And the banker, whatever wealth he accumulated, was never quite respectable. Cicero himself died violently, of course. His head was brought to Mark Antony by soldiers who killed him. Antony's wife Fulvia reportedly shook the head, pulled out his tongue, and stabbed it with her hairpin. A pointed commentary on what happens to men who make careers out of words. By the time Julius Caesar was maneuvering for power in the 60s BCE, he was in serious financial trouble. He had spent years climbing Rome's political ladder through the most expensive means available: public spectacles, lavish games, political bribes, and patronage networks that required continuous, ruinous expenditures. His creditors were so aggressive that before he could even leave Rome to take up his military command, they moved to prevent his departure entirely. It was only when Marcus Crassus, the wealthiest man in Rome, personally guaranteed a substantial portion of Caesar's debts that the creditors stood down. That's worth sitting with for a moment. The man who would become the most powerful figure in the Roman world couldn't leave the city to command his army until his banker vouched for him. Caesar needed money. Gaul provided it. The Gallic campaigns from 58 to 50 BCE transferred an enormous amount of precious metal from tribal treasuries, religious artifacts, and mines to Roman hands, and from there into Caesar's. He returned from Gaul extraordinarily wealthy. He left deeply in debt. The transformation was not accidental. It was the plan. And then, in January of 49 BCE, Caesar crossed the Rubicon with his army, an act explicitly prohibited by Roman law, triggering the civil war that would end the Republic as a functional system. His political opponent Pompey and much of the Senate fled Rome. And Caesar, facing a war to fight and armies to pay, did what most powerful men in desperate financial straits have always done. He raided the treasury. The Roman treasury, the aerarium, was kept in the Temple of Saturn, the oldest sacred site in Rome, which also housed the tablets of Roman law. It was overseen by auditors called the quaestores aerarii, officers of the public coffers who kept monthly registers of every transaction: incoming, outgoing, amounts, names, and dates. A tribute named Lucius Metellus attempted to block Caesar's access, using his legal right of veto. Caesar's response was direct. He threatened to kill Metellus if he didn't get out of the way. The keys to the treasury, it was said, could not be found, so Caesar's men broke down the doors. What they removed was staggering. Ancient sources confirm 15,000 bars of gold, 30,000 bars of silver, and 50 million sesterces in coin. A separate contemporary account places the contents differently, roughly 17,000 pounds of gold, 22,000 pounds of silver, and 6 million sesterces in coin. But either way, the scale of the seizure was enormous. Caesar took the financial foundations of the Republic and put it towards paying his legions. This is the moment when Roman finance shifts its center of gravity. The treasury's wealth becomes the army's operating capital, and the army's success becomes the source of more wealth. The loop is closed. Conquest funds coins. Coins fund soldiers. Soldiers produce conquest. Now, before Caesar leaves our story, we need to talk about what he did to Roman money itself, because it was genuinely transformative. In 44 BCE, Julius Caesar became the first living Roman to place his own portrait on Roman coinage. Coins feature deities, legendary ancestors, mythological scenes, not living men. A portrait on a coin implied divine or semi-divine status. Putting your own face there was a statement that invited comparison to kings, which in Roman Republican culture was the most dangerous possible association. Caesar made it anyway. He'd seen it done across the Hellenistic East, where kings put their faces on coins since the time of Alexander. The Lydian kings, who minted the world's first coins sometime around 600 BCE, had used portrait coins as instruments of royal propaganda from essentially the very beginning. The Persian king Darius I's gold daric coins bore his image as a royal archer. None of this was new. What was new was doing it in Rome, where the practice carried explicit political meaning, and where it was immediately understood as such. Caesar's monetary reforms went beyond the political symbolism of his face on a coin. He introduced the gold Aureus into regular circulation, using it specifically to pay his legions. He centralized mint operations and imposed standardized weights and purity across silver and bronze coins. He expanded the number of mint officials to manage the dramatically increased volume of currency that conquest had made both possible and necessary. All of this was, at a structural level, the financial expression of military expansion. Conquest produced the metals. The metals became the coins. The coins paid the soldiers, and the soldiers produced more conquest, and Rome's expansion into regions rich in precious metals, Spain's silver mines, which previously funded Carthaginian power, and later Dacian gold, gave Rome's monetary system a resource base it never had before. Central Italy is notably poor in silver and gold. The Republic had always been constrained by simple scarcity of raw materials for money. Caesar's campaigns changed that. The gold to silver ratio Caesar worked with was approximately 12:1, 12 units of silver equivalent in value to 1 unit of gold. This ratio wasn't fixed into law by any modern sense. It fluctuated with the supply of each metal, which in turn fluctuated with military outcomes, the productivity of specific mines, and the quality of plunder flowing into Rome. Later emperors would introduce deliberate debasements that would complicate these ratios in ways Caesar couldn't have anticipated. But the system he established was the foundation on which all that came later. The surge of metal flowing into Rome from Gaul, and the new mints producing coins at unprecedented volume, created a practical problem that a specific professional class was perfectly positioned to solve. Enter the money changer. Money changers operated from benches, the Latin word banca, which we eventually derived the English word bank, typically set up near harbors, markets, and commercial centers where coin circulation was heaviest. Their core function was conversion, taking coins of uncertain or foreign origin and exchanging them for locally accepted currency at a fee, of course. But as Rome's monetary economy expanded, their function expanded with it. The most pressing problem they addressed was counterfeiting. Ancient forgers had developed a toolkit that would remain essentially unchanged for the next 2,000 years. The simplest method was clipping, shaving thin slivers from the edges of genuine coins, collecting the metallic dust, and then melting it down to produce fraudulent pieces. A related technique called sweating involved agitating a bag of coins so that the friction between them would produce a fine metallic dust at the bottom of the pouch. Collected and melted, that dust could be cast and struck into counterfeit coins. The most sophisticated producers produced what was called fourrés, from a French term meaning stuffed or filled. These were coins with a base metal coated with a thin layer of genuine silver or gold, either by dipping the core into molten precious metal or by wrapping it in a foil and striking it under dies that bounded the layers together. A well-made fourré could be visibly indistinguishable from a genuine coin, especially in the quick transactions of a busy market. Money changers developed an impressive detection toolkit in response. The touchstone was the primary instrument for assessing gold fineness. A specific dense stone, usually basanite or fine-grained slate, across which a coin was scratched to leave a streak whose color indicated the metal's composition. For suspicious pieces, there was density testing. But perhaps the most effective detection method was acoustic. Experienced money changers could ring a coin against a hard surface and listen. Pure gold and silver produce a characteristic strained ring. A fourré with its base metal interior produced a duller, shorter sound. The genuine coins sounded different. And here's the thing I find fascinating. The association between physical soundness of money and monetary reliability became so embedded in everyday language that when we describe money or banks or financial institutions as sound today, there's a credible argument that we are preserving a metaphor that originated with ancient money changers listening to coins ring on a counting bench in the Roman Forum. The language of financial reliability is much older than we think. When a suspected forgery couldn't be identified by touchstone or sound, the ultimate test was the chisel, cutting the coin open to expose its interior. Destructive and definitive. Money changers also served as a check on government debasement. When imperial authorities quietly reduced the precious metal content of official coinage, as would increasingly happen in later centuries, money changers were often the first to detect it and publicize the change. They would price the debasement of coins accordingly and enforce a kind of market discipline on monetary policy, whether or not the government welcomed the scrutiny. While money changers handled the micro-level machinery of the monetary economy, Rome faced a fundamental administrative problem as it expanded from an Italian regional power into a Mediterranean empire spanning dozens of provinces. It lacked the bureaucratic capacity to directly manage the full range of functions that imperial governance required. Tax collection across remote territories, infrastructure construction and maintenance, military provisioning for armies operating thousands of miles from Rome. None of this could be handled by the relatively small senatorial and magistrate class that constituted Rome's permanent government. Rome's solution was characteristically pragmatic. It outsourced. The vehicle for this was the Societas Publicorum, or the Publican Society. These private organizations composed of investors called soci, or soci, I'm not really sure how to pronounce it, but they pooled capital in exchange for shares, entitling them to a portion of the profits. Management was handled by a senior partner known as the magister, while day-to-day operations were carried out by agents, clerks, and subcontractors across the relevant provinces. Shares could be divided, transferred, and according to some sources, initially traded among investors, allowing risk to be spread across a broad base of participants rather than concentrated in individual hands. The most lucrative activity of the Publicani was tax farming. Rather than collecting provincial revenues directly, the Roman state auctioned collection rights to the highest bidder. The winning society paid the state a fixed sum up front and then set about collecting as much as possible above that amount, keeping the surplus as profit. Rome got predictable, immediate revenue. The Publicani got powerful incentives for aggressive extraction. This made them deeply and widely despised. The constant association of tax collectors with exploitation and moral failure in ancient sources and in the Gospels, which reflected Mediterranean attitudes of exactly this period, which was not accidental. When the New Testament treats tax collectors as symbols of moral corruption, it's reflecting a livid reality that anyone in the Roman world would have recognized immediately. Beyond taxation, publican societies constructed and maintained roads, aqueducts, temples, and harbors under long-term state contracts. They provisioned Roman armies with food, clothing, weapons, animals, and transports. Private capital had become structurally linked to imperial military expansion. Senators were technically barred from direct participation in these companies by law, but many invested indirectly through equestrian intermediaries, maintaining the fiction of non-involvement while collecting a share of the profits. The equestrian order dominated the publican the same way it dominated Roman commerce more generally, occupying the economic space that the senatorial ideology placed limits to the governing class. In practice, the aristocratic disdain for trade was a performance. The money still flowed upward. Now, this begs the question, how do these institutions compare to the chartered trading companies of the early modern period? The Dutch VOC and the British East Indian Company are obvious comparisons, and they're illuminating precisely because of where they break down. The Roman Publicani were private shareholder partnerships, not legal persons in the modern sense. They existed by contract with the state for fixed terms, negotiating at intervals. Shares were informally transferable, but not standardized or openly traded on anything resembling a market. They operated under Roman authority and depended entirely on Roman political and legal structures. The Dutch and British charter companies, by contrast, were legally chartered corporate entities with perpetual legal succession. Their shares were standardized, transferable, and in the case of the VOC, openly traded on the world's first stock exchange. Most significantly, they held quasi-sovereign powers. They could raise armies, wage war, administer justice, and govern territories. The East Indian Company, at its height, governed a subcontinent larger in population than all of Europe. The Roman publicani operated under state authority. The charter companies often replaced it. The publicani monetized state functions. The charter companies monetized the empire itself. Both blurred the lines between public power and private profits, but at very different scales and with very different institutional architectures. What connects them is the underlying logic. When states need to mobilize capital and organizational capacity beyond what their own institutions can provide, they turn to private investors and offer them a share of the profits of the empire. Rome figured this out in the 2nd century BCE. The Dutch and the British made it the organizing principle of the early modern world economy. The logic is the same, the machinery is different. While the publicani handled the macro level financial machinery of the empire, individual bankers were doing the micro level work that kept the Roman economy functioning. Banking in Rome occupied a different social position than it had in Athens, where bankers, even the very wealthy ones, were looked down upon as appropriate only for foreigners and freed slaves. Roman attitudes were somewhat more accommodating. The professional Argentius, the silver dealer and banker, wasn't beneath the dignity of successful equestrians, and some of Rome's most prominent financial figures were men of genuine social standing. The Argentarii first appeared sometime in the 4th century BCE as money changers, just as in Greece, and had expanded their services over time to include taking deposits, transferring funds by check or account, advancing credit to clients, lending to bidders at auction, and facilitating money transfers through what functioned like bills of exchange. They had their own guild and occupied shops along the Via Sacra in the Forum. A small arch called the Arcus Argentorium still stands at the entrance of the Forum Boarium today, a gift from the money changers. The most famous Roman financier of the late Republic was Titus Pomponius Atticus, born January 3rd, 106 BCE, died December 7th, 43 BCE. His nickname tells you something important about him immediately. Atticus, derived from Attica, the region surrounding Athens, acquired during the roughly 20 years he spent in Athens from around 85 to 65 BCE, a period when he moved there partially to escape political turmoil consuming Rome during the Sullan Civil Wars. He emerged from Athens fluent in Greek culture, deeply connected to the Hellenistic intellectual world, and with a reputation for philosophical cultivation his Roman contemporaries found impressively cosmopolitan. Atticus was not a retail banker in any conventional sense. He didn't run a specific banking operation serving ordinary customers. He was what we might today call a private banker, a lender to elites and to cities, a manager of substantial wealth on behalf of trusted clients, a sophisticated investor in property, lending, and other income-producing assets. His fortune came from inheritance, careful investments, extensive property holdings, and lending operations that extended across the Roman world. His lasting fame derives largely from one important relationship: his lifelong friendship with Cicero. Atticus was Cicero's publisher, using his large staff of educated slaves to produce copies of Cicero's works for distribution across the Roman world. The correspondence between the two men, much of which survives, provides an extraordinarily detailed window into the Roman elite financial and political life in the final decades of the Republic. Much of what we know about how wealthy Romans managed money, navigated death, and survived political upheaval comes from those letters. What made Atticus remarkable beyond his financial success was his political neutrality. Despite his wealth, his connections, and his intimate knowledge of Roman politics at its highest levels, he refused throughout his life to hold public office. In a period when virtually every wealthy individual of his class was being pushed towards factional commitments, towards Pompey or Caesar, toward the optimates or the populares, Atticus remained genuinely neutral, maintaining a relationship across all lines and surviving the proscriptions that destroyed many of his contemporaries. He died in 43 BCE, the same year Cicero was executed. He had the extraordinarily rare combination of great wealth, deep knowledge of a dangerous world, and the temperament to navigate it without being consumed. About a century later, in the prosperous port city of Puteoli near Naples, a very different kind of financial operation was underway. Puteoli was at the time the primary point of entry for grain and goods arriving from Alexandria. Before Astaia, Rome's eventual purpose-built harbor replaced it. Each year, merchant fleets would leave Alexandria laden with wheat from the Nile Delta. There was also wine, textiles, and luxury goods from as far away as India, and they made their way to Rome on a voyage of a month or two. The food supply for a city of over 1 million people depended on these voyages. And the funding for the entire operation came not from the Roman state, but from private investors, with the risks and the profits accruing to the individual participants. Which raises a question. What legal and financial institutions made this large-scale international trade possible? A remarkable set of wax tablets was recovered from the Puteoli, and it gives us an unusually detailed answer. These tablets recorded the dealings of the Sulpici banking house, a firm of financial intermediaries whose archives preserved hundreds of individual transactions from the 1st century CE. The financial writer David Jones had reconstructed this operation in extensive detail, and what emerges is a picture of remarkable sophistication. And here's just one example from 37 CE, so this will help you understand how complex and how thoroughly thought out this was. A freedman named Gaius Novius Eunice borrows 10,000 sesterces from another freedman who executes the agreement through his slave Hesuchus Eunice and pledges collateral of 7,000 mode of grain, which was about 2,000 cubic feet, along with 200 sacks of chickpeas stored in a public warehouse. A second document extends the loan by 3,000 more sesterces under the same terms. Then a third document shows Hesuchus arranging the storage space. A fourth document confirms the ongoing debt, and a fifth documents interest owed at 1% per month on the outstanding balance. This is a fully formed credit transaction. Collateral explicitly pledged, insurance contractually arranged, a banker with ready credit at the center of the operation, and all this is conducted by freedmen and slaves, not the equestrian class. But the connections to the upper classes are clearly visible in the background. A later tablet identifies Hesuchus as a slave of Gaius Caesar Augustus Germanicus, the Emperor Gaius, known to history as Caligula. The emperor had either inherited or purchased this particular slave, who continued his financial dealings for his new and very powerful patron. The Sulpici raised their own capital by borrowing from higher up the social hierarchy, including, the tablets reveal, a loan of 94,000 sesterces from a slave of the imperial household. So to break it down, the architecture works like this. Senators and wealthy equestrians lend to financial intermediaries. who lend to traders, who pledge physical goods as collateral, who finance the shipment of grain to Rome. Each layer is protected from the direct involvement in trade in ways that preserve the social fiction of aristocratic distance from commerce. It is a financial architecture designed as much for social camouflage as for economic efficiency, and it worked remarkably well. The most sophisticated single document surviving from Roman finance is a contract for financing a shipment of trade goods from India to Egypt by caravan and Nile barge to Alexandria for onward transport to Rome. A financial agreement that crossed multiple continents and legal jurisdictions. Rome's sphere of commercial influence was, at its height, extraordinary. About 75 years after Atticus's death, a very different kind of Roman banker was conducting business in the prosperous city of Pompeii. Lucius Cilicius Licinius was an Argentarius, a banker and auctioneer active in Pompeii in the mid-1st century CE. We know about him with unusual specificity because of what survived the eruption of Vesuvius in 79 CE. In the ruins of his substantial home, archaeologists discovered over 150 wax tablets, sealed financial records preserving receipts for auction transactions, loan agreements, and payment records from roughly 27 to 62 CE. These tablets are an extraordinary primary source for understanding how Roman financial transactions actually worked at the local level. Not the grand monetary theory of imperial policy, but the specific mechanics of how provincial bankers conducted business, managed clients, and recorded his dealings with the people of a mid-sized Italian city. Licinius operated as an auctioneer and intermediary, as well as a direct lender, facilitating the sale of property, goods, and significantly, enslaved people. There's some scholarly debates about whether Licinius himself may have been a freed slave who had risen to substantial prosperity through banking, which would make his role in the slave trade a particularly complex historical irony. He likely died around 62 CE, the year of a major earthquake that damaged Pompeii significantly, as his home appears to have been passed to his sons shortly before the final eruption 17 years later, which preserved everything it contained for the next 2,000 years. His tablets are, in a sense, the most vivid snapshots we have of Roman retail finance at the street level. Every loan, every auction commission, every signed receipt, frozen in volcanic ash, and recovered centuries later, tell us how much money actually moved in a Roman city. Following Caesar's assassination in 44 BCE, Rome entered more than a decade of brutal civil conflict. The Second Triumvirate, which was Octavian, Mark Antony, and Lepidus, unleashed systemic political violence through proscriptions that eliminated Republican opposition and transferred enormous wealth to the state through confiscation. The final confrontation between Octavian and Antony ended with Octavian's victory at Alexandria in 30 BCE. Antony and Cleopatra took their own lives. Egypt, the richest province in the ancient world, passed under Roman control. In 27 BCE, the Senate granted Octavian a package of powers and the honorific name Augustus, institutionalizing what was functionally one-man rule within the formal shell of republican institutions. The Roman Empire had begun. The financial challenges Augustus inherited were formidable. Decades of civil war had disrupted agricultural production, drained the treasury, destabilized currency, and created uncertainty that suppressed commerce and investment across the Mediterranean. The Republic's fiscal model heavily dependent on conquest, plunder, irregular tributes, and emergency levies, was neither reliable or sustainable as a permanent basis for imperial governance. The option of borrowing from private bankers, filling the treasury gap through something resembling sovereign debt, was not meaningfully available. Roman state finance did not operate like a modern treasury issuing bonds to capital markets. The institutional architecture for public debt markets simply did not exist in the ancient world. It would not be invented until the Republic of Venice pioneered formal state borrowings in the 1260s CE, more than 1,000 years later. And even if borrowing had been feasible, the political optics would have been damaging. The mighty emperor of Rome, appearing dependent on private financiers, would have undermined the authority he was working to consolidate. Augustus' solution was structural tax reform. He expanded direct provincial taxation, creating a more systemic and predictable revenue base than the Republic's patchwork of tribute and tax farming that had been provided. He reformed the publicani system, reducing the worst abusers of aggressive tax farming through increased centralized oversight. He introduced new taxes, a 5% inheritance tax on Roman citizens, a 1% sales tax, and provincial land and poll taxes. Provincial land taxation became the single most important revenue source of the imperial system, the backbone of what would fund the Roman army, the grain supply, and the administrative machinery of the empire for the next several centuries. And it worked. Augustus flooded Rome with the treasury of Egypt. Interest rates fell, house prices rose, and a period of relative stability and prosperity followed in what Rome would later call Pax Romana, or Roman peace. Not because war had ended, but because the machinery of the empire was finally stable enough to function. The Roman financial system was not built for fairness. It was built to concentrate wealth upward through elaborate chains of intermediation that preserved the social fictions of an aristocratic culture while capturing the profits of an empire. The senators who disdained trade profited from it through equestrian proxies. The aristocrats who looked down on bankers borrowed from them, invested through them, and occasionally had their accounts serviced by their slaves. But it was also more sophisticated than it's often given credit for. The Sepulchri tablets show a system capable of financing international grain shipments from across multiple jurisdictions with explicitly contracted insurance and interest. The Argentari on the Via Sacra handled money transfers, deposit taking, and credit for the city of over 1 million people. The publican societies built and maintained the infrastructure that held the empire together. Rome didn't invent finance, but it scaled it. It took the instruments of the Greek banking world, the Babylonian credit contracts, the Phoenician maritime loans, and deployed them at the empire-wide scale across dozens of languages and legal systems in service of a military command complex that connected Britain to India through a single monetary zone. Over the next several centuries, it let that zone slowly dissolve through debasement, political instability, and the structural pressures we'll be exploring in future episodes. But that's next time. That's a wrap on this episode. If this is the kind of history you want more of, the best thing you could do is leave a 5-star review and pass it along to someone who would appreciate it. Word of mouth is everything for an independent show like this one. If you want to support the podcast directly and help keep it going, you can find us on Patreon at patreon.com/historyofmoneybankingtrade. Or you can visit us at moneybankingtrade.com. Until next time, I am Mike D. And this has been the history of money, banking, and trade.